Most people focus on returns when they think about their investments. And why wouldn't you when you've invested to grow your money? But be careful, focusing solely on average returns can be misleading when comparing investments. If you're not also looking at how much risk was taken, you could find yourself comparing apples with oranges, and that's potentially dangerous. On average, higher risk investments generally earn higher returns over the long run. But if you need to access your money in the shorter term, you might not be able to stick around long enough to get the average, as you could be forced to sell assets when markets have fallen. Locking in losses can be damaging, so it's prudent to take only as much risk as you need. The appropriate asset mix for you will depend on how soon you think you'll need the money. Generally speaking, younger investors can probably have a higher risk portfolio than those approaching retirement. So that means a portfolio designed for younger investors can generate a higher long-run return, but has a greater chance of losing money over the short run. Consider an investment option that invests only in shares. Over the long run, you can expect to earn 8 or 9% a year, but it comes with risk. If you'd invested just before the global financial crisis of 2008, your share portfolio could have lost around half its value in a year. If you'd needed to access your money at that time, you would have been forced to sell at a big loss. Most people prefer a diversified portfolio, which has an allocation to growth assets like shares, as well as defensive assets like cash and fixed interest. While this diversification reduces the risk, it also reduces the long-term return. So you need to know how to make the right trade-off. Simply comparing the average returns of two investment options might tempt you to just switch to the one with the higher return. That's when comparing apples and oranges can be dangerous. Past performance is really not a good guide to future performance, and choosing your investment option based on past returns is like driving by looking in the rearview mirror. A better way is to consider how much return you need and how much risk you can afford to take. This is unique to you, and a financial planner can help you find an investment option that fits the bill. One that meets your return objectives, but isn't going to be so risky as to leave you in a difficult position. So the next time you're at a barbecue and hear someone talking about their great investment returns, ask yourself, how risky was that investment? How much might they have lost had things turned out differently? After all, people rarely talk about investments that went the other way. Your financial planner can help you understand how much risk you're taking and can help you to compare investment options based on risk-adjusted returns.